Let's get right into it. There's a real puzzle unfolding in Nepal. You've got a country that's facing a serious cash crunch and a ton of economic uncertainty. And yet, while most businesses are hitting the brakes, some very sophisticated investors are flooring it straight into one specific sector: ultra-luxury hotels. So what is going on? Why would anyone build a five-star palace in the middle of a struggling economy? Well, the answer, as this quote really nails, is that this isn't about tourism at all. It's a defensive move. It's a flight to safety. See, these aren't just hotels. You have to think of them as financial fortresses. The core idea here is that these are actually complex financial instruments, perfectly engineered for a fragile economy. And that's the paradox right there. As critical sectors like manufacturing and trade are starved for cash, you see this smart money pouring into high-end hospitality. Now, this isn't just about finding a safe place to park capital. Oh no. It's about finding an asset that's been designed to actually thrive on the very economic weaknesses that are crippling everyone else. And that is the absolute key to understanding this. These investments are deliberately engineered to turn economic headwinds into tailwinds. So how exactly does that work? How do you build something like that? Well, it's all built on a brilliant concept we're calling the dual asset engine. Okay, so this engine has two incredibly powerful parts, and they work together perfectly to generate returns and protect the initial investment. It's a strategy that really capitalizes on the unique financial landscape of Nepal, zeroing in on the dynamic between its currency and its land. So, what is a dual asset engine? Let's break it down. Part 1. Your revenue, your cash flow, comes in a hard currency. Think US dollars from international tourists. Part 2. This dollar-earning business is sitting on a physical asset, prime land, whose value is measured in the local Nepali rupee, and which, historically, just keeps going up. Let's look at why this is so incredibly powerful. For a typical Nepali business, say a manufacturer, a weakening rupee is an absolute disaster. The cost to import their raw materials just skyrockets, but their revenue is all in local currency. It just crushes their profit margins. But for one of these luxury hotels, it's the exact opposite. Their prices are set in dollars, so when the rupee weakens, they automatically earn more rupees for the exact same room. The country's economic weakness literally becomes their financial strength. And here's a super simple example. A $500 room rate brings in more and more local currency as the exchange rate falls. That little 5 rupee shift, that means an extra 2,500 rupees per room per night for doing absolutely nothing different. It's an automatic built-in shield against currency devaluation. But, believe it or not, that's only the first half of the engine. Now we get to the second part, and this is what makes the strategy so incredibly robust. The US dollar revenue gives you the cash flow, sure, but the land the hotel sits on, that's the store of value. You have to understand, in Nepal's economy, land isn't just a place to build. It's the primary way people preserve their wealth. It's a vault. And you can see exactly why right here. You've got a volatile stock market. You've got inflation eating away at any cash you have. So prime real estate has consistently been the most reliable way to protect and grow capital. The investor gets the best of both worlds. A dollar-earning business sitting on top of a rupee-denominated asset that just keeps appreciating. It's a killer combination. But there's still a third absolutely crucial layer to this fortress. And this is where the strategy becomes almost unbeatable. The value isn't just created by clever financial mechanics. It's protected by something even more powerful: government-enforced scarcity. This creates a deep economic moat that competitors simply cannot cross. You see, if you want to build one of these luxury lodges in a pristine, protected conservation area, you have to navigate this regulatory labyrinth. It is a long, incredibly complex, and very expensive process. And by design, the number of permits available is severely limited to protect the environment. This isn't a bug in the system. For the investor, it's a feature. And the results of that labyrinth? Scarcity by design. The government essentially creates a near oligopoly. If you're one of only a handful of lodges allowed inside a national park, you have unbelievable pricing power. Your operating license itself becomes an immensely valuable asset, and your long-term returns are shielded from any new competition. You've built a fortress. So let's pull all these threads together. When you look at all the pieces, the currency hedge, the appreciating land, the regulatory moat, it becomes crystal clear. This is not a speculative bet on a tourism boom. It's a deeply strategic, defensive play designed to preserve capital, with the potential for massive upside. Let's just summarize the key differences here. The luxury hotel? It has a natural currency hedge, a dual asset base of cash flow and appreciating land, and competition is severely limited by regulation. A traditional business, on the other hand, is exposed on all of those fronts. Structurally, in this kind of economic environment, there's just no comparison. But there is one major risk we have to talk about. And here's the catch. The greatest strength of this entire investment is also its greatest weakness. The government acts as the gatekeeper. It creates all this value through regulation. But that same gatekeeper can also take it all away in a heartbeat. What's really fascinating, though, is how the asset adapts. If the economy stays fragile, the hotel's value as a financial hedge only gets stronger. But if the economy stabilizes and the rupee strengthens, well, that hedge matters less, but the investment just seamlessly morphs into a pure growth play on a booming tourism sector. It's almost designed to win in either scenario. But let's be very clear about this. The hard truth is that for all this clever financial engineering, the biggest threat isn't a market crash or a recession. It's the state. The very entity that creates the value in the first place also holds the power to completely destroy it. And these are the specific risks we're talking about: a sudden change in conservation policy, a new punitive tax on foreign currency earnings, a major shift in property laws. Any one of these things could completely undermine the investment thesis overnight. An investor isn't just buying a piece of real estate, they're buying a huge slice of political and regulatory risk. Which leaves us with this one final critical question. In this incredibly unique investment strategy, the power of the government is what creates the scarcity and therefore the value. So, is that power the ultimate asset that underpins this entire fortress? Or is it the ultimate liability, a single point of failure that could bring the whole structure crashing down? That is the high-stakes paradox at the very heart of investing in Nepal's financial fortresses.